Hello, everybody. Hi there. How are you? I hope. Good morning. So we are going to two things we're going to do today. One, we are going to, if I think I mentioned we would do the quiz today as a class. So I'm just going to let you know that the quiz for chapter 8 is only one problem. Okay? And they're basically journal entries of exactly what we kind of went over in class. They're about 6 journal entries. It's one problem. We're going to keep it simple. And what I'd like to do is start with the chapter 9 PowerPoint, if you guys are cool with that.
I'm cool with that.
Oh, good, Clark. Now, Joe said he was going to join us, so I hope I see Joe. Who's called in online?
Aaron?
Dan?
Aaron's called in online.
Good. Aaron, hey there. Okay, so guys, we're just going to start, and I am using the screencast. I'm recording it also, so everyone will be able to go over this. So this chapter is primarily talking about long-lived assets, and we're going to cover the highlights of this chapter. We're not going to get into every single detail. What are plant assets? We know an asset has a future benefit. Plant assets are going to be a physical. They're not intangibles. You have to be able to see a plant asset. The key with them, plant assets are used in the operations of the business. They are not part of inventory where you sell them. This is kind of the area on the balance sheet we call property, plant, and equipment. This shows a list of the plant assets of various companies. Plant assets, property, plant, and equipment. It's going to be the building. It's going to be everything inside of it, the equipment. And so here you can see Microsoft, being that it's a technology firm, has very little in property, plant, and equipment. I'm surprised Caterpillar only has 18%. Wendy's, I'm assuming just because of the buildings, they're related to the whole. Their assets, the property, plant, and equipment of their assets consist of 72%. We always record the plant assets at the cost we purchased them for, plus all the expenditures to get them into service. Now, the capital expenditures that involve the cost of the asset is generally what you purchased it for, plus any shipping, sales tax, and those expenses that get it ready to be modified to place into service. And for the most part, we capitalize those costs. So basically, the cost is what we paid. And if we do a trade, say we give up an asset in exchange for another one, we will usually equate it to either what we've given up, the fair value, or the fair value of what we've received. Generally speaking, when we're dealing with cash, that's very determinable. But when we are doing some type of exchange, we've got to come up with the value of the asset based on either whatever we've given up or whatever we're getting. Land is never depreciable. Never ever. But land, if it's used in the operations of a business, would be part of property, plant, and equipment. To determine that cost of the land, you not only take the price you purchased it for, you take all the other costs that you incurred to purchase the land. So as you see here, the closing costs, broker's commissions, if you had to pay them, any back property taxes and liens, all the costs to purchase that land will all be capitalized in the land value. So the example we have here is Hayes Manufacturing, a company, acquires real estate at a cost of $100,000. The property contains an old warehouse that was taken off at a cost of $6,000. Additional expenditures are attorney fees and the broker's commission. So in determining the value of this land, we're going to take the cash price. We're going to take what it cost us to remove the warehouse because we want to use the land. The warehouse is on the land. We've got to get rid of it. The attorney fees and the broker commission. So our entire cost of that land that will show us on the balance sheet would be $115,000, not just the $100,000. Now, when we have land improvements, that's going to be something different from just the land. We will be able to depreciate land improvements. This basically, these types of cost will be items that we need in order to utilize the land. So driveways, fences, landscaping, sprinkler systems, all of those have a future benefit, but they will be used up. So we will be able to depreciate land improvements, but we cannot depreciate just the land. Buildings, again, the cost of the building plus whatever cost we incur in order to place that building in service will also be capitalized. If we don't purchase a building but we construct a building, then all those costs in constructing the building are all going to be capitalized into the final product. Same with equipment. I think we've gone over some of this before, but the cost of the equipment, the shipment, the sales tax, and then anything that you have to do to get it ready for service will all be capitalized in that equipment. So in this scenario, Leonard purchases a delivery truck at a cash price of $22,000. In addition are sales taxes of $1,320. Okay, what did Aaron, you were just telling me something.
I was telling you something?
Oh, I saw you type something. Maybe it wasn't me. Sorry.
Oh, I'm sorry.
No.
I was helping Jill out with the audio.
Oh, good. Hey, Joe. Okay, so the expenses, the delivery truck and the sales tax, any types of improvements on that truck, the license, the insurance. Well, the insurance is going to be an expense, but all the cost in getting that truck in service, we're going to be able to capitalize. The cash, the sales price, the painting and lettering. The motor vehicle license is an annual cost, and so that, I stand corrected there, will be expensed each year. And then the insurance policy, if it's a 3-year insurance policy, we'll treat that as a prepaid insurance and then expense it as it expires. So we have the delivery truck of $22,000, and then we'll add to that our sales tax and any improvements on it. So we're going to do a journal entry to show how we're going to record that delivery truck. We could treat it as a delivery truck or we could treat it as equipment. So we'll take the $22,000, the $1,320, and the $500 to give us our total cost of the equipment. Then our license expense will be written off in the period. The Insurance will be a prepaid insurance of $1,600, and we'll credit our cash. So as each month expires or as the year expires, we will debit our insurance expense and then credit our prepaid insurance. Now, a lot of people hear about leasing versus purchasing assets. What's better? The lease is an agreement where the owner lets you, the leasee, use the asset on a certain price. So we know that you can lease an apartment. You never own it, but you get to use it. There's some advantages of it. If we're worried about equipment that may become worthless or lose its value quickly just due to technology, maybe leasing's a better idea. You don't have to have a lot of capital outlay when you lease. You can just start renting or leasing the machine. The tax advantages are instead of depreciating the asset, you get to just expense that lease payment each period. And as a result of a lease, it's a pure expense. We're not showing an asset on our books with an increased liability. Now, this is what we call an operating lease. There is another type of lease called a capital lease, which is handled a little different. But for a pure operating lease, you're using it for a certain amount of time. You use it for a certain price, and when you're done during that time, you give it back, and it's done. That's a lease. Depreciation we know about is when there's an asset on the books that provides for us a future benefit. We take a portion of that asset because we're using it up over the useful life of that asset. So depreciation basically allocates an expense over the useful life. And we generally depreciate items based on what will determine the useful life of an asset to be. We can depreciate anything, but we cannot depreciate land. So, why do we depreciate? This is a little example here. We get a brand new truck. It comes right off the lot and loses value because you could never then sell it for what you purchased it for. The useful life is basically what a normal truck of this nature how long it would last. Sometimes with certain equipment, it's based on hours of operation. That might be an easy way to determine it. Sometimes with trucks, it's based on miles. Other times we base it on years. But basically, over the period of time, that truck is going to lose value. And basically that depreciation will help us capture as an expense on the income statement that cost of utilizing that asset over its useful life. At the end of the life of an asset, generally speaking, there's something called a salvage value. The salvage value is just what we can sell this asset for, just for their parts. Sometimes there are salvage values, sometimes they're not. We estimate what we determine the salvage value to be. So in this example, say we purchased this truck for $50,000. We're going to use it for 5 years. And then over its useful life, we think after we're done with it, we can sell it for scrap for $2,000. So we'll actually be depreciating $48,000. The $50,000 we purchased it for minus the salvage value of $2,000 at the end of the period. Remember, all of these are total estimates because we don't have a glass ball to be able to look into the future to see exactly how long assets are going to last us. Now, we get to depreciate or take a cost for this asset throughout its useful life. And there's a couple various methods that are commonly used to depreciate assets. As you can see, the most common is what's called the straight line method, where we take a flat amount, so our $48,000 divided by 5 years, we come up with an amount, and we take that amount each year. There is a declining balance method where we accelerate the depreciation in the beginning years, and so we're depreciating a lot more with the assumption that our value is going to decline more rapidly beginning, and then it really tapers off to a lot smaller amount of expense towards the end of the period, which we'll talk about. And then units of activity basically can occur when we're dealing with numbers of hours of machine life. So if there's a machine that we know will give us 500,000 hours, and in the first year, if we've used 50,000 of those hours, we would take that percent based on machine life or units of activity. So in this example, we're going to show the various depreciation methods and how we're going to come out with different expenses based on the depreciation. Bill's Pizza purchased a delivery truck on January 1st, 2012. The cost, $13,000. The expected salvage value, $1,000. The estimated useful life in years is 5 years, and in miles is 100,000 miles. So we're going to determine what the depreciation is going to be based on these three different methods. Under the straight line, it's very straightforward. Straight line is straightforward. We're basically going to take the cost of 13 minus the salvage value to have a depreciable cost of 12. The 13 minus 1, 12. We're going to divide that into 5 years, and our annual depreciation expense is $2,400. It's going to be the same amount each year. So, as you can see here, it continues each year to be $2,400, and as you see what happens, our accumulated depreciation increases. We know our book value is based on what we purchased it for, cost minus accumulated depreciation. So each year, we started with $12,000 as a book value. But at the end of 2014, you see our book value, our adjusted basis, is only $10,600 because we take our $12,000, subtract our accumulated depreciation to come up with a new book value. Then in 2015, we depreciate another $2,400, which increases our accumulated depreciation account, that contra account, another $2,400 up to $4,800. Our adjusted basis, or our book value, will be our $12,000 minus $4,800, or $8,200. Same with year 3 and year 4. We just continue to reduce our book value as we're increasing our accumulated depreciation account. So the first year, when we record depreciation, we'll debit our depreciation expense of $2,400, and we'll credit our accumulated depreciation of $2,400. You can see in the last year, we didn't depreciate that salvage value because we know that's what the value is going to be that we can get for it. So we've depreciated everything down that we've anticipated of $12,000, and it ends up leaving us with a book value of $1,000. Now, what we're going to do here is we're going to still do straight line depreciation, but instead of it being a clean year, we're going to purchase this asset on April 1st. So basically what we'll do is we'll allocate this asset for the months in a year. Since 3 months have already gone by, and we are now purchasing the asset, we will show our annual expense of $2,400, but for the first year only, we're only going to take 9 months out of 12 months for the year because we purchased it April 1st, so we've got April, May, June, July, August, September, October, November, and December in depreciation. So we don't have a full year there, we've just got $1,800. Now, the other years we're going to keep taking the full year, but in the final year, because we're depreciating this over 5 years, but since the first year we only took 9 months, in the final year, or the portion of the 6th year, we're going to take that remaining 3 months of depreciation. So we're ultimately going to depreciate it entirely down, except when we're dealing with a partial year, we're only going to take so many months of that first year, and as a result then, in that 6th year, we're going to take the remaining. So for an asset that was purchased on April 1st, and we're only going to be able to take $1,800 of an expense for that year, we'll debit our depreciation for $1,800, and we'll credit our accumulated depreciation also for $1,800. Now here's another method we're going to look at. It's called the double declining balance or declining balance. It accelerates it at the beginning of the period, and then as we've gotten 3 and 4 years into this asset, the depreciation drastically reduces. Basically, in this method, it's double the straight line rate initially. So we'll look and see how this works. We start a book value with $13,000, but the double declining rate, we know that over 5 years, straight line would be the asset divided by 5 years, or 20% of the asset. What we do here is we double it. Now we're going to decline it at 40%. So where the normal straight line rate would be 20, we're going to take 40%. So $13,000 at our 40% gives us $5,200. So we'll show that $5,200, and our book value will be the $13,000 minus our $5,200, or a new adjusted basis of $7,800. The second year, we're going to take that book value of $7,800, multiply that times 40% to come up with a depreciation expense. We'll add that to the $3,120 to our already accumulated depreciation account to come up with now an accumulated amount of $8,320. We'll take our $13,000 from $8,320 to come up with a new book value. Again, we'll start year 3 with our new basis of $4,680 at our 40% and show our annual expense there of $1,872, which gets added to our accumulated depreciation. Now, the most important thing that we need to note is when we finally get to it, we can't reduce our book value below our salvage value. So in year 4, I don't think we're there yet, 2808 at 40%, we've got our depreciation. We add that to our already taken accumulated, whoopsie. Sorry guys. Sorry, 1 second. Okay, sorry.